Good afternoon, ladies and gentlemen. If you want to understand the real financial story of 2026 so far, do not just look at the stock market, look at the bond market. Because the bond market has been sending a warning loud and clear, and it's impossible to ignore. As of March 24th, 2026, what we have seen in both the United States and Europe is not a calm return to lower rates and easy money. It has been the exact opposite. This year began with hope that central banks might finally get breathing room, but instead, 2026 has brought rising yields, inflation fears, energy shock, heavy government borrowing, and deep uncertainty on both sides of the Atlantic. In America, the year started with investors asking one big question: would the Federal Reserve finally be able to cut rates? But underneath that question was another problem, one far more structural: the sheer weight of the U.S. government debt. Analysts warned early in the year that long-term Treasury yields were likely to stay high, or even rise, because inflation was not fully defeated. Growth was still holding up, and Washington's financing needs remained enormous. Then March brought a major shock. War involving Iran sent oil prices sharply higher. That changed the whole mood of the bond market. Normally, investors run to government bonds in times of crisis. But this time, the fear was not just war, it was inflation. And that meant Treasury yields moved higher instead of lower. The message was simple. The market was beginning to believe that inflation could stay sticky and rate cuts might be delayed or reduced. By late March, the numbers told a story. The U.S. 10-year Treasury yield was back in the area of 4.4%. The 30-year Treasury was again pushing toward 5%. And that is not a small move. That is the bond market telling the world that borrowing costs are staying elevated and that investors demand more compensation to hold long-term debt. And what does that mean in pure plain English? It means mortgages stay pressured, corporate borrowing stays expensive, government financing stays difficult, and the dream of a smooth, easy return to cheap money starts to fade. Now turn to Europe, where the story has been just as serious, and in some ways even more dangerous. Europe entered 2026 with inflation appearing softer and with hopes that the European Central Bank could remain steady. But Europe had a major weakness: energy vulnerability. When the Middle East conflict intensified and oil surged, Europe felt inflation threat immediately. That is when the European bond market began to shake. German bond yields rose sharply. British gilt yields pushed to levels that stunned investors. Traders who had been looking for rate cuts suddenly had to reconsider whether central banks might be forced to stay tough for much longer. In some corners of the market, investors even started thinking in terms of hikes interest rate instead of cuts of interest rates. But Europe had another problem on top of inflation: fiscal pressure. Germany, traditionally seen as the bedrock safe haven of Europe, began to face scrutiny because of rising spending plans and the prospect of more debt issuance. That matters because even Europe's safest borrower starts losing some of its safe haven shine. The entire region feels the stress. And when warning grew louder, by March 24th of 2026, fresh economic data showed the Eurozone economy was close to stalling. Even as inflation risks were being pushed higher by war and energy costs, that is one of the worst combinations a bond market can face: slower growth, but not clean disinflation. Weakness without relief. So here is the big picture in 2026. The American bond market has been warning about persistent inflation, huge treasury supply, and higher for longer yields. The European bond market has been warning about energy shock, fiscal strain, and a weaker economy trapped under inflation pressure. Different systems, different central banks, but the same message. This is why the bond market matters so much. Stocks can celebrate, headlines can distract, politicians can spin, But the bond market is harder to fool. And in 2026, it has been saying the world is entering a more expensive, more unstable, more dangerous financial era than many expected just a few months ago. So when you look back on this year, do not say the story was just about interest rates. Say clearly, 2026 has been the year the bond market forced investors to wake up. In America and Europe, bonds have stopped acting like a quiet refuge and started acting like an alarm bell, and the bell is ringing.